Okay, so should we let's continue from the topic that we had finished yesterday. So it was the end of the last video and the beginning of the next video. So let's finish that topic, then we'll come to the larger issues that you guys have raised about trading strategies and all that, approach to trading. Is that okay? We'll continue with the topic that we discussed yesterday. So yesterday I'll just give you a quick rundown of what we were discussing. We had gone back to one of the decision problems, which if you see, okay, so you remember that one of the decision problems that we have, one of the decision problems that we encountered or we discussed while discussing the decision problem that exists in the case of management of an investment fund. Okay, one of the decision problems towards the end is how to exit at a profit or where to exit at a profit. Okay, so once you enter the position, two things can happen. Either the position goes against you, in which case you should get stopped out, okay, and you should have a stop in the market. And the other situation that can happen is the position can start going in your favor. Okay, in this case the question arises, like suppose you buy dollar Swiss here. Okay, we can make this a little bit maybe bigger, and do we have 2 hours? Let's try 2 hours. Okay, so the thing that can happen is if I buy dollar Swiss here at 99.70, and then it can either go down and then have me stopped out. Let's say if I have my stop at 99, or the other thing that can happen is that it can actually start, my view might be right, and it may actually start going up. Okay, so please remember, although we are discussing dollar Swiss, which is as far as asset classes are concerned, we are currencies, but all this stuff that we are discussing applies to everything. It applies to all markets and all other asset classes. Okay, that's why we discussed. That's one of the ways one of the different ways in which finance is taught here, which is we don't just discuss stock markets, because there are many general principles of markets which are applicable across all asset classes. So we should not discuss it only as a stock market thing, because then you might think it doesn't apply to currencies or bonds, right? So everything that we discuss here, although the example is taken from currencies, applies to all asset classes. So the other thing that might happen is the market actually might start moving in my favor and might start going up 101, 102, etc. And then the question arises at that point of time, at what point should I lock in? So you are getting profits, okay, you are showing paper profits. Everyone's familiar with this term, paper profits. Okay, these unrealized profits, we discussed that, right? Realized versus unrealized P&L. So the unrealized profits are sometimes referred to as paper profits, okay, or M2M profits. Okay, so M2M typically is referring, although there's nothing in that expression necessarily to indicate that it's referring to unrealized, but M2M profits always refer to unrealized profits. Okay, it doesn't refer to the realized part of the profit. So unrealized profits are piling up in your account. Now the question arises, at what point should I book my profits? Okay, so lock in my profits at what point? So you realize that that's a decision problem, right? You agree that's a decision problem? So we had decided in the previous course when we discussed this, we had actually discussed a case where you use trailing stops. That is, you don't directly solve this problem, but you solve it indirectly by using a trailing stop. You remember that? That was discussed in your, that was asked in your case also. Yes? Yeah? Okay, please nod aggressively, like some of you, like Tanya, Shuchi, are nodding aggressively, but I want to see some other aggressive nodding so that I get a clear picture that you have understood. If you are just sitting there blank, it's very difficult for me to figure out whether you have understood or not. Okay, because if you haven't understood, then I'll explain it again. Okay, so you have to give aggressive nodding. Okay, all right. So now we had in the previous session, in the previous course, we had discussed only how to indirectly solve this problem, which means what happens is, as the market rises, okay, I may move my stop, which was initially at 99, I may move it to 1, then when it has gone to 101, when the market is at 101, and so that's the trailing stop method. But the other way to solve that problem is to directly solve the problem by using a limit order to limit sell order. In this case, I'm buying dollar Swiss, right? So in this case, I can set a limit sell order to take profit at a particular level. It could be 101, it could be 102, etc. Is this clear? That's another way of solving. That is the direct way to solve this problem of how to exit at a profit. That is a decision problem, okay, which is how to exit at a profit, okay, or where to exit at a profit, at what price. Okay, So that's what we discussed yesterday, and for that what we said was that that decision also is not to be taken arbitrarily. Oh, this looks good, there are lots of money, I have lots of money, let's take profit now. That's an arbitrary way, which is unfortunately many even professional traders work like that. Okay, oh, this looks good, nice profit, let's take it. So, and typically the human tendency is to take the profits quickly and run the losing positions, okay, which is exactly the opposite of what you should be doing. Okay, so the way to solve it in a very structured manner, which is consistent with the rest of the assumptions of your trading system, that's what we were discussing yesterday. Okay, so you can go back and look at the rest of the video. I'm just quickly recapping the system, the problem for ourselves yesterday that we set ourselves. Okay, so we looked at this situation where the investor, let's say, okay, in this case our total gross profit that we have realized is 5.625, okay, million, and the invested capital in this account, these are the numbers. This is already in your, so I've named the sheet trade risk. This is already in your notes. Okay, you have access to this file, so you can examine it later. So in this case, the invested capital is $5 million, and you have made a profit of 5.625. So you have a realized, you have a return on invested capital of, this is not RC actually, this is a return on invested capital. So let me just rename that. This is okay, return on invested capital. Okay, I discussed the difference between invested capital and risk capital with you. Yes, okay. Alright, so let's just assume that in this case we are facing a situation where the investor who has given us money is demanding 113% return, and let's assume that this entire analysis, okay, if you remember, Gulati brought up that point yesterday, that whether this is an ex-ante analysis or an ex-post analysis. Right now we are doing, for system, trading system, risk parameters calculation, system edge and all that, you can do it both ex-ante and ex-post, okay, but right now we are doing it as an ex-ante analysis. Our investor has told us that we need to realize a return of 113% on invested capital, okay, which means that I need to produce a return of 5.625. Okay, and therefore this will translate into 113%. Now that involves a certain system edge. Okay, now what is involved in that? So remember, just go back and check. Some of you were not able to recollect what system edge. Nobody actually could remember what system edge was yesterday. Okay, so please go back and revise these concepts. Okay, so now the system edge into the total number of trades will give you the same profit, which is 5.625 million, which is what you're gunning for. Okay, you're planning to do 180 trades and you are planning for a system edge of 31.250. How does that come about? It comes from a 75% loss rate, a 25% win rate, okay, and average loss you have set from previous calculations. We are taking these as given. Average losses, say 42k roughly, I'm rounding it off. Okay, so the total system edge of this figure that you have, 31.250, is coming out of the 75% losing trades. The average loss is 42k and the R3 is 6, so the average win is 250k. Okay, so you remember the system edge formulation? We had discussed it. Yes, we had, I think, maybe rewritten the system edge figure, or we went up. No, so these are not actually rewritten. This was not rewritten yesterday, but we can okay, we will not go back, it will take us a lot of time. Okay, so you remember that system edge is basically percentage winners into average win plus percentage losers into average loss, where the average loss is written with a minus sign. Remember that, everybody? That is just a mathematical expectation of your trading system, which we recapped yesterday. Okay, so that's your system edge. So so you need this so the system edge of 30. So basically this is how the logic works. You need to produce a 113 ROIC of 113%. That means you need to produce total profit of this, gross profit, total profit minus total losses. It needs to be this. That means that the system edge needs to be this, given that you're planning for 180 trades. Okay, now if the system edge needs to be this and you have already got a 75% loss rate budgeted, that means 25% win rate, and you have also got an average loss of 42k, that means that to produce, given all this, to produce the 31.25 system edge, your R3 needs to be 6. which means your average win needs to be 6 times your average loss. Otherwise, you will not have a system edge figure of 31.25k. Okay, or we'll just call it 31k here, rounded. Is this clear? That's how that 6 comes. Okay, in that equation of system edge, there's average loss into probability of loss plus average win into probability of win. Okay, and so therefore, so the point is this 31.25 will not come unless you have an average win of 250k, given that you have an average loss of 42k and a 75% loss rate. Is this clear? You have already done this exercise. This was the last question of your IPM paper, right? Okay, so in the last question we asked you to calculate this system edge, the R3. The last question was calculation of R3, okay, which is a relevant point because these other systems, typically in many situations you will have this kind of setup, that the average loss is determined by your total risk capital pool, okay, and the number of trades you're planning to do, that will determine the average loss. So that is kind of almost given from outside. The investor is going to insist that I need this much return. That is also going to come from outside. So basically you will be faced with this kind of situation where you realize you need a R3 of 6, which means you need an average profit of 250k. Okay, so in this case now, what is the relevance of the R3? That is what we are going to see now. What is another relevance of the R3? When we connect it further to our decision problem, which we just discussed, which is we are now, I bought some dollar Swiss, and now the dollar Swiss has started to move up 101, 102, etc. And now I'm wondering, where should I take my profit? So I'm dealing with the decision problem of 7, which is basically, the numbering is not important. Okay, the decision problem I'm dealing with is the decision problem of at what price level should I, or at what profit amount should I exit my position when it is a profitable position. Is this clear? We are dealing with this. So we'll see how the R3 comes into play to help us solve this problem. Okay. All right. So what we did was we saw that. So this is what we saw. For that we need. So this is the problem that we have. Now the problem, basically this is our problem. Where should I exit my winning position? At what price level? Okay. So to solve that, we set up some equations yesterday. We'll just this, we had actually made a mistake. What we did was, remember when we took this position into when we broke up the bracket and moved one term to the left side, we forgot that the profit also should have been moved. It was supposed to be divided by the profit, so that also should have moved. So that's why we were not getting the right answer. Okay, so I'll just wipe out this part and copy it from here. Okay, let me just copy it from here. So I'll wipe out this entire part here. So these are obviously not a very happy way of writing equations, but we are just doing it here because I don't know how to use the other software. There's actually some good software. Have you guys heard of this software called LibreOffice? LibreOffice is a free, many of you might know people, or you yourself might be using pirated versions of MS Office. Yes. Okay, many people do that. That is very bad because it's very bad. Bad means not immoral, but just bad strategy, because you could get viruses. So, or when you get a pirated version and you can't patch it, you don't get to patch it through an Office update, and those unpatched versions, the old versions, are more vulnerable to virus attacks. Am I right, cybersecurity man? Okay. So, all right. So therefore, what you should do is, now many people don't understand there are many very good pieces of software which are free software. So you can tell everybody about LibreOffice, which is a free software, and it's a full-featured replacement of MS Office. And it's got some other modules also. It's got a math module where you can actually write equations, and it doesn't have to be written in such an ugly manner. Look at this.
So even in MS Office we have that module.
Oh, you have that? Okay. Okay, I didn't know that. But I didn't know about that. Okay. So is this clear? Okay. All right. So this is now what we are doing is, so understand the context. We are trying to solve the decision problem which is basically at what price do I exit my profitable position? Okay. And we are making use of the R3 concept, which is R3 is average win by average loss. Okay. Please make sure you're very comfortable with all these concepts. Okay. So all right. So for that, first what we do is we write the profit expression. Okay, remember the profit expression, which many of you messed up in your IPM exams, because in this case what is happening, what is the terms asset in this particular, what is the terms currency in this case? Swiss franc. Who said US dollar? Who said US dollar? Somebody said US dollar. So anyway, so the terms asset, remember the rule, the profit in P&L is always happening in the terms currency. P&L always happens in the terms asset. Okay, so remember that rule. And then so the terms, so therefore when you are going to compare the, and remember that in your system it's a dollar based system, this 42k is a US dollar figure. So you can't compare a Swiss franc loss to a US dollar figure. Okay, you can't benchmark it. So you have to convert the US dollar figure to the Swiss franc figure to a dollar figure. So that's why in this case the profit expression needs to be written as, obviously the profit is position times, here I've written it directly like this. If you write it like this, you will always get negative signs when there is a loss and positive when there is a profit. Okay, for long position is profit position into exit price minus, and this is all in your notes. You don't need to write down the notes. You just focus on what's being discussed. This whole thing has been pasted in your notes. Okay, the outline notes. So this is just position into exit price minus entry price divided by exit price. This is the formula for the profit. This will give you the dollar profit. This is the dollar profit on dollar Swiss franc trades. Okay, the dollar profit on dollar Swiss franc trades. If you are doing trades where the dollar is the terms currency, like Aussie, Euro, okay, in that case you will not have to do this last part here. This exit price is not required because it's directly giving you a dollar profit or dollar loss. If you're trading euros, then dollar is the US dollar is the terms asset, right? If you're trading Aussie, Kiwi, in all those cable, if you're trading cable that is sterling USD, all those cases US dollar is the terms asset. So in those cases you don't need this last part of the expression EXP. In that case your profit expression becomes only this, because the profit is directly coming in the dollar in dollars, because usually what happens is that the risk capital numbers and the maximum loss number, etc., those are expressed in US dollars. Okay, so but sometimes, and then there is the other type of problem that you can get is that if you are trading sterling yen, in sterling yen what is the terms currency? Yen. Okay, so then becomes even more complicated. Okay, because you have to now convert the yen loss and profit into a dollar figure. So therefore you have to then insert, instead of the exit price, you have to insert the dollar yen exchange rate which is prevailing. Are you following what I'm saying? Go back and think about it. Nothing. You just have to remember this basic principle, two basic principles. First is that P&L is always generated in the terms asset. Second is that typically, may not always be the case, but typically your risk capital numbers and maximum loss numbers are going to be in US dollars. So you can't compare a yen figure to a US dollar figure, because you have to make sure that your loss on the trade is equal to the maximum loss and not more. Okay? Are you following what I'm saying? Is everyone following what I'm saying? Okay. Okay. So these are all the nuances, okay, that you have to be aware of. Okay, so this, I'm not going to go through the working, but if you go through the working now it is correctly formulated. What are we trying to solve for here? Let's be clear about that. What are we trying to solve for, Sukriti? In this problem that we have set up, you understand the names here. Profit is the profit. Okay, profit here is basically what is the profit I'm gunning for, because remember this equation has been set up for the purpose of helping me to determine at what price should I exit my winning position, my money making position. At what price should I exit it, so that I make the necessary amount of profit required, okay, under the constraints of my system. And what are the constraints of my system? Investor wants 113%. Okay, given all the other parameters of my system, the only way I can deliver this is if my average profit is 6 times my average loss. So in dollar terms, my average profit has to be 250k. So this 250k goes in here. Okay, but what are we solving for in this? How should we set up this equation? What are we gunning to? We are trying to model, we are trying to write a mathematical expression to model the what as a function of what else. Is my question clear? You understand the logic? You understand the lingo that we are using? You need to be able to use the right lingo. When you are doing your Gordon growth model, when you are doing, do you remember the Gordon growth model? You better remember, because otherwise DG sir will catch you. Okay, so Gordon growth model, what are you modeling in the Gordon growth model? Is my question clear? Yes? No, you don't understand my question, or you don't know the answer?
I don't know the answer.
You don't know the answer. Anybody knows the answer? Everyone's clear about the question? In the Gordon growth model, what are we modeling? Yes, Pulikit is almost there. Fair value of the stock. Okay, so you can say, to make it even more clear, you should say fair value, but it's a correct answer. So it's not the price of the stock. It's not the price you can see from the market. You are modeling a fair value. To make it very clear, to make the distinction between price and value very clear, you should use fair value, which means this is according to your subjective assumptions. What should be the fair value or the correct value of the stock? Okay, is this clear? So that's what you're modeling. So on the LHS you have the fair value of the stock, and the RHS you have the current dividend divided by R minus G. If you have a growth rate, a constant growth rate of dividends, or if you have constant dividends, then it's just D by R. Okay, so that's what you have to. So in that sense, I'm asking the question now to Sukriti. Are you following what we are saying? So in this case, what are we trying to model? I explained these are the terms. This is the position, this is the profit, this is the exit price, this is the entry price, and same exit price. So when we are writing this equation and trying to manipulate the terms, what are we trying to end? What's our goal? What are we trying to model? Because whatever we are trying to model, that will be either on the answer is clear now, that will be on the RHS or LHS. That's where we want to get to, right? Is my question clear? Yes? Am I talking Japanese? Are you able to understand what I'm saying? So the question, Sukriti, what is the answer? Is my question clear to you? What is the answer? Yeah, so in that case, in the terms of this equation, then what would that be? What are we trying to model if with reference to the terms here? What are we trying to model? The exit price. Okay, so somebody else, you should have answered. Yeah, you told me, but you have to answer in terms of what has been written here, exit price. Okay, yeah, I understand. Okay, so as long as you're clear about that. Okay, so we are trying to model, so we want to just the objective of all this manipulation is to get the exit price out on one side. Okay, so that we can express the exit price. Are you following?
Yes.
That earlier Gordon growth model you understood?
Yes, sir.
Okay, you're trying to model the fair value of the share. Okay, so now in this case you're trying to model, you're trying to write a mathematical expression to model the exit price as a function of the other parameters of your system. Okay, so the other parameters are basically the required profit, which in this case is 250k, because you know you have to make 6 times your average loss. Okay, this will go in as 250k. In terms of, so the language is that you're trying to model the optimal exit price, okay, as a function of the targeted profit, the position size, okay, and the entry price. Yes, Shreya, is this clear? What are the three exogenous variables in this model? Exo. Which are the three? I've already given you a hint that there are 3 of them. Okay. Exit price is an exogenous variable.
Entry price.
Yeah. Then.
Position.
Okay. Actually, my number of there are actually 4. No.
4. So.
Yes, folks, anybody else wants to give us any input? Mehak, now again you're sitting next to your buddy, but today thankfully you're not talking that much. Okay, now Mehak, please help Shreya. Exit price is not an exogenous variable. We are asking you about the exogenous variables.
So what is the meaning of exogenous? Can you just explain?
Exogenous has been explained. Please go and look up the videos. Please, somebody give him some exogenous input so that he can understand what.
Useful.
No. Exogenous is not useful. Now we had this entire discussion. Maybe you were not there in the class. Please go and look up the video. Okay. So we had a discussion. So the 1 minute, guys. Okay. Let's quickly recap. Okay. In this case, the exogenous variable is once we see the final solution, this is what we are modeling. So we took it to either one side, left side, right side, and we are modeling it as a function of, there are actually 4 exogenous variables. So when I said 3, that's not correct. Okay, there are 4 exogenous variables, position size, okay, entry price, position and profit. Okay, some of these are all, yeah, is this clear? Yeah. Oh, I'm sorry. It is 3 only. Sorry. I'm so sorry. Why did I have the impression that it's 4? Yeah, there are actually total of 4 and 1 you are modeling, so there are 3. Okay, I'm sorry about that. Okay, all right. So is this clear now? Please be clear about the link. Now we have found that there's one person who has received an A in IPM but does not know what an exogenous is. Okay, so this is what happens. Some of the freak things that happen that Surbhi was pointing out, that because in trading the results are unpredictable. Okay, so you may put in a lot of effort. Some team may have put in a lot of effort, but because there's a big element of luck involved. So that's what I was telling you, that even highly very, very successful fund managers can end up losing money. People who have made money for many years. So there's a very famous fund manager called John Paulson, who made $16 billion in the year of the financial crisis, 2008. Okay, because he was short all those mortgage-backed securities, which collapsed in value. So he made some obscene amount of money, like 16 billion. But that guy has been basically struggling ever since. So since 2008, he has been continuously struggling to make money, and his assets under management is continuously declining. Okay, so I use 2 terms here. One term that we use in the industry is AUM. AUM is assets under management. Okay, and the other thing that I use was OPM. OPM stands for other people's money. Okay, so many people have. So what has happened is, in many cases, like John Paulson, he's still managing OPM, but many other successful fund managers like Leon Cooperman and many others actually they are so frustrated by the results that they are getting in the markets. They're not able to make money. They are returning outside investor money and just managing their own money. Okay, so the point that Surbhi has raised is actually a very vital point, which is even when you refine your own trading method and you are putting in a lot of effort, okay, you may still lose, and it may seem very unfair, but that's how life is. That's how the markets are. Okay, so but that's a basic reality of thing, which is actually everybody is facing that. You can't escape from the market. Look at everybody. Even if you're not involved in financial markets, even companies face that problem. You see many things like Reliance, the younger Ambani, his companies are in big trouble because they have not been able to manage the debt load well, and their revenue, they're not getting enough revenues. You can have a lot of debt. If you have substantial revenues, then you can still cover everything. But somehow he was not able to generate the returns in his businesses. So being an Ambani, having all that money, that's not a ticket to success. You can see that, right? So that is a basic uncertainty of life and of the economy and the financial markets, which you can never accept. So you should be mentally prepared for that. That you may put in a lot of effort, you may have a very well designed trading system, but eventually, but still your results will be a disaster. And some other guy might just not put much effort and get good results. But that will happen only 1 year. If you don't have a good system, you can't continuously produce good results. Okay, so that's what we were talking about. Now, why did I get into this discussion? Why did I move into this part of people losing money? What were we discussing? Exogenous variable. Then I said that he doesn't remember what exogenous is. Oh, trading. Okay, he got part of the reason he got an A is because SG1's group got the highest marks in the trading. Okay, and then I do everything as relative grading, right? So their team got 100% on the grading on the project component. And then I set the lowest bar, and arbitrarily I decide what the lowest team gets. So if I decide the lowest team is going to get 30%, then based on the actual score, the raw score difference, that is scaled proportionately. So these guys will get 100% and the lowest team will get 30%, and in between everybody will get the same distance. It will be proportional to their actual scores. Okay, so I think I've shown you the scoring in lab. Didn't I show you the scoring in lab?
Yes.
So if somebody scores 80 and then the lowest team scores 20, then the difference between the two is 60. And then if I set the lowest team as 40% and then the highest team is 100%, then there's a 60% difference. So if your score is, let's say, 80, then you'll get 80% because it's just proportional to your score. Okay, once I've defined the boundaries. Okay, so from the scores it's objective, but the problem with a lot of things, see, I can't police everything. Yeah.
So you've taken NAV as the score?
No. I did not take NAV as the score. Remember, I told you the score is, let's say your return was, the score is basically NAV divided by maximum drawdown. Not NAV, not even NAV. The period return. Period return, that also you should actually know how to calculate. I'm sure you guys won't be able to calculate that if I test it. Okay, but I'm sure many people may not be able to calculate. We should do that testing. I spared you guys all those calculations. Actually, you should be taught to write the formula for drawdown. Okay, understand drawdown and write the formula. But what I'm doing is I'm sparing you guys. So I took the period return. So you traded for 20 days or whatever days. Okay, so in that period you make a period return. Okay, so you started with $100. If you end up with $10, that means your period return is 10%. Okay, so if your drawdown is 2%, make sure Garvit come back on time.
Yes, sir.
Don't go on holiday. Okay. So if your period return is 10% and your maximum drawdown is 5%, then your score is 2. Okay, so somebody can actually have a lower period return than you and have a higher score than you because their drawdown is less. Their maximum drawdown is less. Are you following the logic? Okay, so I can see one problem with your trading, with your project trading, is many people are not trading actively. The level of activity is quite low. But then you're cheating yourself. Now I can't police at every level. You guys are graduate students, so I can't police you guys at every level. Okay, so this project opportunity is given to you. You have access to live data with very high quality feed. Then you have all these option prices with the eyeballs being highlighted. Also, the software is so advanced. Okay, if you don't make use of it, you are actually missing out the opportunity to learn. Okay, because I can't police at every level. Then I have to start giving people grades for trading more actively, which is not really correct, because you don't have to trade. That's not a good kind of incentive to force people to trade actively. Okay, so these things, these problems are there, but you have to basically take advantage. I can't police at every level. Okay, all right, so let's go back to I don't know where I was, but let's go back to this. So we were talking about exogenous variables. Okay, so here there are 3 exogenous variables, and we have modeled the exit price as a function of these other things. Okay, and we can plug in these values of these exogenous variables quite easily, because we know that based on other system calculations, we have the position size, which you can go back and calculate from yesterday's video. You can watch and figure out why this came out to be the position size. Okay, because our entry price was 99.70, our exit price at a loss was 99 figure. Okay, and we had to lose we could only lose 42k. So therefore this position size was determined in such a way that if you do this position size, you enter at this price, exit at this price, then you lose 42k. Okay, that's why this position size comes out. So once you put all this in, this formula is now correct. Okay, the exit price is now properly being modeled, position into entry price divided by position minus profit. If you do this calculation here, okay, you can figure out for yourself how you can go through this derivation. This is just algebraic manipulation. There's nothing to do with finance actually. Okay, once you put it in like this, once you put it in this form, then the finance stops. Then you just move into maths, and then this is just maths, and then you finish it, and then you come back here, and then you do position into entry price. This is position into entry price. You see position into entry price. Okay, I'll show you. You see that? Position is this one, entry price is this one. Okay, are you guys following? If you don't follow, please raise your hand and ask me to repeat. Yeah.
So if we have to calculate the position, then we should know the entry and the exit price.
Yeah, so
On
those.
the other page we are calculating the exit price. So for that we should know the position.
No. There is no circularity. There is no circularity, because we are talking about two. Remember, we are talking actually. This is this exit price. We should maybe give it a better label. This is this exit price. One sec. Let me just redo it. So all cases of this exit price, let's call it exit price. It is actually exit price at profit. Okay, so let's call it exit price plus. Okay, so all the exit prices here, they should be called exit price plus, to show that they are talking about the exit price at a profit. Okay, and there is no circularity because the quantum of the position size, okay, just like you do in your equity price when you're discounting earnings to arrive at the fair value of the stock. Okay, you're discounting earnings by, what should you use, what, cost of equity or WACC? Who said WACC? Earnings. Earnings are to be discounted by cost of equity. Okay, so in that model, the cost of equity is one of the what? Endogenous or exogenous? In the equity fair value model, where you're deriving the fair value of the stock, okay, as a function of various things, in that model, the cost of equity is an exogenous variable or an endogenous variable? Exogenous. Because the endogenous variable here is the fair value of the stock. I should have waited for Garvin to come back before asking the second exogenous variable question. When you're discounting earnings, future earnings, you're discounting projected earnings to arrive at the fair value of the stock. Okay? Right? You're familiar with that exercise? Just like no different from dividends. Instead of discounting dividends, you're now discounting earnings. Okay? So when you're discounting earnings, then to derive the fair value of the stock, there the endogenous variable is the fair value of the common stock. Right? Yes? People are not nodding aggressively. And then the endogenous variable is cost of equity. But to derive the cost of equity itself, you had to go through another exercise using the CAPM cost of equity model, where the cost of equity was now the endogenous variable. Yes? So the same kind of exercise we have done here, because we know that the position size will be an exogenous variable here in this equation, in this model. But therefore we had to previously decide the position size. Here the position size was an endogenous variable, where position size is written as in this form. Where the position size is written in, where would be this? I deleted that part. So we don't have that here. But position is written as this. Okay. The position is derived from this equation once again by treating the position as an endogenous variable. Okay. Is this clear? We have decided. So there is no circularity, because whatever are the exogenous variables in this model, okay, for the exit price model, they have already been derived from previous calculations. The position size, which is 5.8, has been derived from a previous calculation, so we know the value. Okay. The entry price, we know, we have determined the entry price. The exit price, this is exit price minus. Okay, this should be called exit price minus, because it's the exit price on loss. And this exit price, we are calling it, let's label everything quickly together, so that this is exit price plus, okay, to indicate that this is exit price on profit. Okay, so please remember that. Exit price plus, and exit price plus, exit price plus, and exit price plus. Okay, exit price plus, exit price plus. Okay, have I done it correctly? Because to me, it's such close range, I almost can't make out the difference in entry price and exit price. They're looking the same to me. Okay, so I think I've done it correctly. Yes? Okay, because I'm too close to the screen. Okay, so alright, so now you've understood this problem, everybody? Yes? Shivam? Are you following what has been done? Okay, so all the exogenous variables in this model, okay, which is position size, entry price, and profit. Okay, both have been, so out of this, entry price was just arbitrarily decided because I decided to go long at 99.70 because I wanted to go long at market. Okay, so that is kind of arbitrarily given. But the other two exogenous variables in this model were determined, they themselves were determined by treating them as endogenous variables in a previous exercise. Right? Because I had to model the position size, the optimal position size, as a function of entry and exit, with the constraint that the loss must be equal to 42K only. So that's how we modeled this figure. And then the other one is the profit figure, which we got as 250K, because in order to make 113% ROIC, with all these loss restraint constraints, okay, loss rate and the maximum loss, average loss, therefore that 113% return can only be produced if we have a 6 times R3, which means the average win has to be 6 times the 42K, which is this. Is this clear? So you had two previous exercises where you needed to solve the answers to model the targeted take profit on winning trades in dollar terms. How much profit should you realize when you exit on a winning trade? Yes? How much profit you should realize, at least basically, which is another way of saying, at what, instead of saying what price should I exit at, how much profit should I accumulate before I exit from a winning trade? That's another way of saying it. Instead of saying at what price, you can monitor your M2M profit, and you should have a plan in your mind that I will exit only when I get to 250k M2M profit. Okay, so that 250k, where does that come from? That comes from this earlier exercise. Okay, so you are familiar now with the structure where exogenous variables in a particular model may themselves have been modeled earlier as endogenous variables in a previous model, in some other model. Okay, so that you have a clear-cut value as exogenous variable in the next model. Okay, now where are we here? So we got the exit price. Now we can test this. So Gulati, this is the answer you got yesterday.
Sir, actually yesterday you gave us the entry price minus exit price.
No, because yesterday I made a mistake. No, when I moved this to the left side, I did not move the profit in the denominator. This is what happens when you do equations like this, because you can't make out properly.
You gave us position into entry price minus exit price. You didn't give us exit price minus entry price. Yesterday you wrote it in that.
Yeah. But that's why I'd use absolute value. Okay, and then we deleted it. So it makes because this is how it should be written. If you write your equations like this, you will find for the long position, I think even for shorts it will be the case. If you take a short position, okay, then your exit price, this is for the previous case where you're having even if you have a loss, let's say. So if you have a short position, your exit price will be higher. So in the case of the short position, you have to write the position with a minus. This formula will work even for shorts. Okay, this is when you are calculating profit and loss, not for this calculation. Okay, let me just give you this calculation input once again. Okay, let's do it this way. This is a separate problem. Okay, okay, this is only for, I'm not writing that, okay, where the terms currency, this is modeling trade P&L, okay, we'll call this scenario 1, which is scenario 1 is where the P&L is being generated in a currency which is different from the currency in which your maximum risk and figures are calculated. Okay, so terms currency is different from, and there's another element of this. So basically this is, let's say scenario 1 is example. Okay, we'll just do it as an example, it's easier, but then I don't have to write that much. Risk cap, okay, in USD, risk capital figures are in USD, okay, and trading in USD CHF. Okay, so the properties of this scenario is basically here your risk cap means your maximum dollar loss figure, all that is coming out in USD. Those boundaries that you have to stay within, those are in USD. Okay, risk cap figures are in USD, but you're trading in dollar Swiss. So therefore the dollar Swiss, the P&L will come out in Swiss francs. You will have to divide it by the exit price, whether profit or loss, to arrive at the dollar loss of the trade. This is clear? Yes? Okay. Now there could be another type of scenario which I told you, which is, we are not going to write that here, where your trade, the risk cap is in dollars. Okay, let's write other scenarios. We are eventually we end up right, but anyway, good. Since you guys are still not clear about a lot of other things, okay, let's write this. Now what we have is scenario 2. Okay, in all scenarios we take risk cap in US dollars, then you can change it later on. Now you're trading in okay, this is a situation where scenario 2, where the P&L currency, there is no adjustment required here. Here your P&L is basically directly entry minus exit, absolute value of entry and exit into the position size. Now we are going to eliminate the absolute value by writing the expression in a particular way, which is what Gulati noticed, that there's a slight change in today's writing. Okay, now are you following so far? If you're not following, please interrupt. Yes, Simran, you're following? Okay, Don't switch off and go into your WhatsApp. Stay focused, okay? Everybody at the back is following? Okay? If you don't follow any step, please ask. If you don't ask, it's not possible for me to watch everybody's expression and figure out that you have not understood. Okay? So please interrupt and ask a question. Okay? So, we are now going to write an expression, a general expression for modeling trade P&L. Okay? There will be, yeah.
Can you please explain the calculation for RC that 113% calculation? I'm a little bit concerned.
Okay, we'll come to that. Just remind me after this, okay? So, we'll come to that. Let me just finish this part now, okay? So, this part everybody has understood? How we model the exit price? This is just algebra, nothing. You can just see it yourself and check it. This is correct. I've cross-checked the figures with a numerical example, okay? Everybody has understood here what we were trying to do? We were trying to, because all this is basically forcing you to think about trade risk and risk management, because risk management is everything in trading, okay? Even in when you're doing corporate treasury risk management, like Anjum was saying that I'm not going to go into trading, I want to go into corporate. But even if you go into a corporate treasury, you still have to have the same skill set. You need to understand financial markets inside out. You need to understand risk, because as we will see in IFM, there's not a whole lot of difference between managing an investment fund and managing risk for a corporate treasury. If you're managing risk for Air India, if oil prices go through, Air India of course has a big daddy in the government, they'll always bail them out. But if you're managing risk for Indigo, and who doesn't have a big daddy, then if oil prices go through the roof, okay, like what we had here, right? When we saw oil prices, you saw the chart of oil prices. In 2007, they went to 147.47, okay? And many airlines were going bankrupt as the price was rising through 135, 140. Many small regional airlines were going bankrupt because nobody had budgeted for that kind of high level of the oil price. And oil price is about the fuel expense is about 50% of operating expenses for any airline. So those guys were basically just knocked out. So even in a corporate world, you have to watch out for risk. As you can see, I gave you examples like even a big company like Reliance Junior Ambani, his companies are a mess now basically because he has not been able to manage the risk properly. So he started out with all that capital and everything, but he's made a mess of it. So even in every business, risk management, and eventually it will come down to being able to manage market risk and follow markets. So don't think that you're going into corporate finance, therefore you don't need to follow markets. You need to understand markets and risk. All these risk considerations will apply even in a hedging scenario, okay, where you're hedging risk for a corporate, okay, because you have a limited amount of risk capital that you can allocate to that activity. Okay, so everybody has understood this part, okay, where we are modeling the exit price on a profitable position as a function of these other variables, because we want to basically, and so the two parts, going back to what Surabhi highlighted, the two parts to your trading success essentially is you must develop over time. It will not happen overnight, okay? So just like some of you did not clear the interviews, doesn't matter, second try, third try, you will get through. So everything doesn't happen overnight. So evolving a good trading system will take time, trial and error, over time it will get better, okay? That's one part of the equation. And the second part of the equation is the sheer unpredictability and the luck. And to protect yourself against bad luck, you need to have really good risk management. And all this structured approach to position taking and trade risk management is basically that's basically the core. That is what will protect you. If you have a structured approach, you are a much better wicket than having a arbitrary approach, okay? So this make sure that your system is internally consistent the way you're trading. That way you have a defense, okay? All right, so this is the first part. Now we are modeling the trade P&L. What are we doing here? We are just trying to figure out how to calculate the trade P&L for each trade, okay? So we have three kinds of scenarios we can look at. One is the first scenario where I'm just explaining this verbally because it'll take too long to write, where the risk capital currency, I'm just loosely using that expression, where the currency in which your risk capital and maximum risk numbers are denominated, dollars, is in dollars, okay? In all scenarios we take that case. And the trading is the trading in dollar Swiss, which means your P&L is happening in the terms currency always, okay? So here the P&L is actually happening in the terms currency, which is different from the risk capital currency, okay? First scenario. But the risk capital currency is part of that market, which means here there's this dollar Swiss. The other asset in this market is dollars, which is your risk capital currency. So in this case, you will be using that exit price kind of formula, which we will write down. Okay, let's understand the scenarios first. The second type of scenario is you are trading in Aussie US or euros or cable. Okay, cable is, everybody understands, GBP USD. Okay, so you're trading in euro dollar FX or Aussie or Kiwi or cable. Okay, where the profit is, where the terms currency is US dollars. So slightly different scenario because the PNL is directly being generated in the currency which is the same as your risk capital currency. So one term will drop out. The exit price factor will drop out. Okay, because the PNL is directly coming in US dollars. The third scenario is there is risk cap in USD trading in, let's say, let's keep it simple, Aussie yen. Okay, very volatile currency pair, Aussie yen. Okay, now you have a slightly different kind of situation. Okay, so you have a risk capital currency which is different, and then you're trading in a market where the PNL currency is different from the risk capital currency. Not only that, but this is scenario 3. Scenario 3 differs from scenario 1 in that the risk capital currency does not even figure in that market. Here you had dollars in the dollar Swiss, but here in the Aussie yen there is no dollar. So here you will have to adjust by, the goal is always the same. The goal is to always convert where it is necessary to convert. The profit or loss, which is always generated in the terms currency, in the terms asset. Okay, the goal is always to convert the profit or loss to the currency in which your risk capital is denominated. Are you following the logic? The goal is always the same. Now you can have 3 kinds of situations. In this case, in scenario 2, such a conversion is not necessary. You observe that such a conversion is not necessary because the dollar is the terms currency, so the PNL is directly coming out in dollars, so I don't have to make any further adjustments. Okay, but the goal should be, the basic logic should, the algorithm should be there to check whether there is a conversion required. Okay, to convert the PNL into the risk capital currency. And these two, you can understand the difference between scenario 1 and scenario 3. Okay, all right. Okay, now what we do is, so we'll just write out, let's say, modeling trade PNL in, this has already been done before, I think it's already in your notes, so I didn't want to spend more time in this, on this, but let's do it this way. Okay, I'm not going to write plus or minus because I think we'll treat it as the same.
So is it for the short position or longer position?
I'm coming to that. Okay, is this clear? This expression is clear to everybody? The dollar Swiss PNL is going to be position into position, which maybe position is to be written for, we'll write one more rule here. Okay, short position, you write, enter it as a minus sign. So the first scenario is modeling trade PNL in dollar Swiss, risk capital in dollars. Okay, so trade PNL is equal to, so we will always write as PNL equal to position. Okay, let's test the long position first. Long position, okay, position, we write it with a plus sign, basically with no sign. Position into exit price minus entry price divided by exit price. Okay, why do we write it like this? As Gulati correctly noticed, there's a slight change in style from yesterday. Long position. Okay, in the long position, when you are took, this is at a loss. When it is at a loss and when it is at a profit, it will come out. Let's take the loss situation first. Let's consider the loss situation. You have gone long dollar Swiss and you have in a loss. This is exit price is at a loss. So in this case, which will be this figure is going to be negative or positive? This expression in brackets.
So negative.
Negative, because exit price will be lower than entry price when you are locking at exit price at a loss. Okay, so then your PNL will come out as negative. Okay, and we are dividing it by the exit price. Why? Because the PNL, if you leave out this last term, if you leave out this term, okay, then you're talking about this part is only going to give you a Swiss franc figure. Dollar amount into Swiss franc entry price into dollar Swiss entry price by dollar Swiss minus dollar Swiss exit price will give you a Swiss franc figure. Okay, that we don't want. We want a dollar figure. Okay, so we have to therefore divide this whole expression by the exit price of Swiss franc, not the entry price. Why exit price? Because that is where the dollar Swiss is at the time you exit the trade. Imagine if this is your last trade, then this you'll be revaluing everything back into dollars because you're actually a dollar based investor. That's why your risk capital numbers are in US dollars. Is this clear? So you have to convert by dividing at the exit price, dividing or multiplying whatever you do by the exit price. Is this clear? Everyone follows so far? This has already been done once before. Now let's take long position, exit at profit. Okay, still the same scenario. We are looking at the second sub scenario. First sub scenario was long position, exit at loss. This one works, this formula works. Now let's take long position, exit at profit. Exit at profit, position is positive sign. Now in this case, expression in brackets is positive or negative?
Positive.
Positive. So net result of all this P&L, LHS is positive or negative? Positive. You're exiting at profit, so LHS is positive. So what we have seen, long position, both the sub scenarios, exit at profit and exit at loss, this formula is fine. Okay, you should practice entering all this into your spreadsheet. You have to develop a feel for all this. Why do I tell you to keep on bombarding your brain with continuous Bloomberg TV, CNBC every night? Because that is how you develop a feel for things. You don't develop a feel just sitting in the class doing WhatsApp, sometimes chatting. That is not intense enough. You have to basically go into the system. I mean, you have to basically immerse your brain in the world of finance, right? Otherwise, you're not doing justice to your whole experience, right? If you're doing something, you do it 100%. Okay? Okay, so you have to practice all this. Now let's go back to see if the formula works for short position, both the sub scenarios, exit at profit, exit at loss. Okay, short position means the position will have a minus sign. Okay, for short trades, write the position with a minus sign. Okay, minus for short position, exit at loss. Okay, in short position, exit at loss, expression in brackets is positive or negative? Okay, I shouldn't blame you because it's not easy to figure out mentally. Short position, what will I do in a short position? I go short dollar Swiss at 99.70 market. I put my stop at 10034. So what is my expression? This is my exit at loss price. This is my entry price. What is my expression? Exit price minus entry price. Figure will be positive. Expression in brackets is positive, but position has a minus sign. Okay, so P&L LHS is negative, which is what we want. It's a loss. Okay, reverse it. Minus sign on position. Exit at profit. Exit at profit. Okay, so expression in brackets will be negative. Okay, because it will be lower than the entry price because of the profitable trade. So expression in brackets is negative, but position also has a negative sign. So net result LHS is positive. Okay, so this formula works for long positions and for short positions. If you write the short position with a negative sign, which is intuitively logical, that is how you would do it. Short position. Okay, it shows you the position size, the leaning of the position. Okay, so long position, entry at exit, profit and loss exits. Short position, profit and loss exits. Do we have any other scenario to cover? We have covered everything. Okay, so from this we can model. Here, what are we modeling? We are modeling trade P&L, but we have only covered one scenario. Yes, what is your question?
The short position portion also.
Yeah, short position, always the position will have a negative sign because we have instructed you to write the position entry. This is like software instructions. Okay, some software may automatically enter it some other way, but the software is basically telling you, the software rule is, if you want to enter short position, enter with the minus sign. Okay, you have sold $5 million, you write minus 5 million. So this will have a negative sign. Okay, now let's look at two scenarios. Why is this formula correct? Writing it this way, you don't need the absolute value figure. Okay, that absolute value operator. Okay, So minus sign on the short position. First scenario is exit at loss. When you are exiting at loss, the exit price, because I go short here at 99.70, I put a stop at 10034. Okay, so so the exit price on loss for a short position is higher than the entry price. Okay, clear? So if the exit price is higher, then the expression in brackets will be positive. Yes, but the position will have a negative sign. Okay, so the net result on the LHS will be negative. Okay, P&L negative, which is what we want because we are modeling a loss scenario. We expect it to be negative. Okay, this is sign neutral. Okay, this is always positive. Okay, so now this is clear. This part, first sub scenario. This is short position first sub scenario, which is the actually sub scenario, because this is a scenario. Then you have a sub scenarios, two sub scenarios, long and short. And then within each of the two sub scenarios, long and short, you have a sub scenarios with everything is included, sub, right? Okay, so that only Piyush got the joke, or some other people also got it. Okay, but you preferred not to laugh. Okay, which is true, which is anyway, it's not okay. So let's get back to business. We have no time left. Okay, position, short position, second sub scenario of the second of the short position. Okay, second sub scenario, which is short position, exit at profit. Okay, when you are going short at 99.70 and exiting at 98, booking a profit. Okay, in this case the exit price is lower than the entry price, less than the entry price. Clear? Magnitude wise, it's less than the entry price. So then the expression in brackets is going to be negative, but it is multiplied with another item which is negative. So negative, negative, positive. So the P&L LHS comes out as positive, which is what we expect because it's a profitable trade. P&L is positive. This is clear? Okay. All right. Okay. So we have covered these cases. This is clear. Now we have to cover the other two scenarios. We'll just copy this thing. Okay. Let's try quickly. Garvit is already getting restless, so we have to hurry up. Train is approaching the station. Garvit is getting restless. We will cover, that means we will not be able to cover option trading material again today. But please revise the thing. So basically what you have to do is you have to watch the videos again and again because we have already covered it. Okay, I'm not reprimanding you for asking the question, but as a technical response to your question, what I'm saying is that if you go through the material, I have meticulously covered, I have given you a very structured approach to solving each of the decision problems that will arise. Is this clear? So it's all in the videos. You have to watch it again and again and read the books, read the references that are given. Okay, read some of the other books which are in your finance reference folder, option trading book by Sheldon Nattenberg, but that will not give you much clarity on actually doing the project. You better anchor yourself in the structure that I've given you. Anchor yourself in that structure. It should solve all your problems. Okay, just repeatedly try to understand. Then if you still have problems, we'll again revisit it when I come back. Okay, all right. Okay, so second scenario, scenario 2. What is scenario 2? Okay, quickly. Okay, I'm just going to quickly wrap up. So Garvit, please tie him up so that he can't get restless. Tie him up and keep him still for the rest of the class. Okay, right. Now what are we going to do now? This part is going to drop out. Is this clear, guys? In the case of Aussie, US, because the P&L is coming out in the same currency in which our risk capital is denominated, so that exit price division business that we had, that we can eliminate now, and we should eliminate because then you'll get a wrong answer. Because the P&L, no adjustment is required because P&L is already coming out in the terms currency which is dollars, which is the same as your risk capital currency. This is clear? Yes, Surbi, you're on board. And the expression, we are not going to retest all the scenarios and the sub scenarios because we know it works. Okay, it will not affect whether it's a Aussie dollar trade or a. This is working because in that particular scenario, the exit price minus entry price, this expression is written in such a way that for long and short, and that will not change. The fact that in a short trade losing scenario, the fact that exit price is higher than entry price That is not going to change from dollar Swiss to Aussie dollar. This is clear. This is clear to everybody? That will not change, because you can just pull up an Aussie dollar chart here and see it will not change. It's the same concept, because in fact should not even need that, because you will see that it does not change. Even in the Aussie dollar, if I'm going short at 67.70 and putting a stop at 69, the exit price on a losing trade, exit price is higher than the entry price. Okay, so the same dynamic will apply. Okay, so everybody knows that we don't have to do anything here. This part of the formula doesn't need to change. This division, the divisor drops out, because PNL is coming out directly in the terms currency. And then what else is here? Okay, third one. In this is not actually, this is the third one is different. I have to copy that. Okay, scenario 3. What is scenario 3? Aussie yen. Scenario 3 is Aussie yen. In this case, we have a further adjustment here. What will happen is this, we can't just use the exit price, because the exit price is a Aussie yen rate. When you're trading Aussie yen, the exit price is Aussie yen rate. Dividing a yen PNL by the Aussie yen rate will not give me a dollar figure. Is everyone clear about this? If I divide the PNL in Aussie yen trading will be generated in yen. So if I divide a Aussie yen figure by a Aussie yen, the yen figure by a Aussie yen exchange rate, it will give me a Aussie figure, not a dollar figure, right? Okay. So therefore, here what I have to use is, I have to use basically this long expression between. Now this exchange rate between terms currency and risk cap. Here, what is the exchange rate we have to use here? Where my risk cap currency is US dollars and I'm trading in Aussie yen. So for the divisor, this whole expression is for the divisor, okay? This is all long English, yeah? Long English language here used, but this is actually meant to tell you what should be the divisor, okay? So can you tell me in this situation where the risk cap currency is US dollars and I'm trading in Aussie yen, so what should be my divisor? What exchange rate? Which exchange rate?
Dollar yen. USD yen.
Dollar yen should be your exchange rate, because what is happening, what is your objective? This part on the RHS, the numerator of the RHS is giving you a yen figure. You're not happy with that because you want to compare the PNL on the LHS to a dollar constraint that you have in terms of maximum risk per trade. So your goal is to convert the RHS expression here, which is coming out in yen, because in Aussie yen, Aussie amount of position, and this will be a yen PNL. You want to convert that yen PNL into dollars, right? If you want to convert yen into dollars, you will have to divide by the dollar yen rate, not the Aussie yen rate, right? And you have to divide by the dollar yen rate. Now let's think about situations where, okay, you're a little bit over time, but it's fine. This is it basically. Yes. So you should practice now programming all this into your brain. Otherwise, it will not go into your brain.
Yes, sir.
And this kind of dynamic, if you go through these exercises, it trains you not just for this specific exercise. You understand? You should understand this value also. That these exercises are not just training you for the specific problems. It is also training you to solve other problems which are similar in the future, because you are getting to know how these problems can be solved. Are you following? So please do these exercises on your own, otherwise it will not be internalized. Okay? Okay, you can release. You had been we had tied up Garvit, you can release him. Okay. Okay, you had a question which we are not able to answer.
That was the calculation of RC ranging to 113%.
Yeah, but let's do that now.
No, sir. Actually, I also have one more question regarding that scenario.
So now at least you're finding interest in the course. In the IPM you were sleeping.
Sir, in the first scenario where we were calculating regarding the short positions, and where you said that if we are entering the market at 997 and exiting at 1.003, so it will be a loss case.
Let's go back to dollar Swiss. Give him the mic. Who has the mic? Because there's a lot of noise. Okay. Dollar Swiss. Use it. You feel like a singer. Okay, I understood your question. I'm fine. Okay, next question. You can use the mic. So we are looking at dollar Swiss losing trade. Okay? Losing trade on a short position. Okay. So you have gone short. So you write the position as a negative figure. You go short at 99.70 and you put a stop at 100.35. Let's say 100.30. Okay. So what we notice is that the exit price is higher than the entry price numerically. Numerically, the exit price is higher than the the exit price is higher than the entry price. So we remember that standard expression exit minus entry.
Yes, sir.
So if the exit price is higher, that means the exit minus entry expression will be positive. Okay. And so we go back here. Exit minus this part of the expression will be positive.
Yes, sir.
But the position has a minus sign.
Negative sign. That is why.
So then the LHS comes out as negative.
So it's a loss.
Right? It's a loss, which is what we expect. What we are testing is whether this formula works if we write it this way. This is more elegant than writing using ABS, because we can use one type of expression for all cases, right? And it's simpler because the ABS operator has gone up. So this is a more efficient formula, right? So is this clear now? That this solution is clear. Okay. Now regarding your, can we go to your other problem?
RC calculation.
Okay.
Of 130.
No, RC is given. See, okay, you're talking about this one. This absolute
Average loss which we calculated that our investor we can assume that our investor can have this much amount of loss of 41.6K.
No. This loss is coming from a different calculation. Remember what we said? Basically G8 by G60. This has to be slightly different actually. What is G8? G8 is because G8 is the total amount of risk capital, which is equal to 100% of the invested capital. G8 by G16, maximum run of losers from the start is 120, but these actually have changed. This is actually this is a different, this is a separate input. It's an independent input into this. Okay, but actually what would happen is you have 100 trades, so losing trades is 135. So this should be rewritten as, I'm not going to write it now because it will confuse you guys. Maybe what we can do is we can set up a separate sheet. Okay, let's duplicate. Okay. We set up a separate we'll call it trade risk trial. Okay, if we write trade risk trial and then we go here, okay, so you're talking about how to arrive at the maximum dollar risk figure.
Yes, sir.
So that we have already done in previous videos. You can check it.
But right now I'm getting a bit confused that we have 25% as percentage winner, and we have RC of around 113%. So
No. RC is not. This is not RC. This is actually
return on investment capital.
Let me write it here.
Investors required.
Now it's better. Okay. This is not RC because that RC was meant to be. This is true. That RC is actually meant to qualify this column G. But I had not planned to write anything in column F, but now I have started writing in column F. So this RC was meant for this. So actually this column F should go to the left of RC. Then it will make sense. Okay. But this is what it is. So this 113% is not the RC. 113% is what the investor has told you that I want this return. Okay. So let's assume that this 41,667 is derived in the way which we discussed earlier, which is you have to tally up your losing trades. What is the projected losing trades total number? then in this case is 135, then you do plus 1 because you should have capital left for one more trade. Okay, so 135 plus 1, you use that divisor 135 plus 1 to divide your total risk capital, 5 million. You divide 5 million by 135 plus 1. In this case the answer is not 41.66 because this has come out for a different figure, for a different set of calculations, but let's assume that by doing that process you came out with 42k. Okay, so now have you got the satisfactory answer to this? That investor tells you, I need 113% return if you want to manage my money. So that tells you that with a 5 million invested capital, if you want 113% return, then it's around 5.625 total profit you have to make. Okay, so if you want to make 5.625 return, that means essentially, and another way to express the total gross profit is system edge into total number of trades. Okay, system edge into total number of trades. Now you already know your total number of trades, so that means your system edge has to be this 31.25. Your system edge has to be this. Okay, so in that case, if your system edge has to be this and your loss rate is this 75% and your average loss is 42k, then 75 also tells you that your win rate is 25%. So then what is the average win that you need to produce? Now you have got one equation in one unknown because you have system edge on the LHS and on the RHS you have average loss into percentage loss. Both those are known. Plus you have average win into percentage win. Only average win is not known. So this is a one equation, one unknown. From here you can figure out the average win and you do that calculation and you figure out that the average win is $250,000. That tells you that the RC is 6. Not C, RC, R3. Reward to risk ratio is 6, which means the average win has to be 6 times the average loss. That is the only way with this kind of loss rate and average loss that you can produce 5.625 to satisfy total profit of 5.625 to satisfy the investor's demand of 13% return. Just clear, right? So now,
can we have a just as an editable one so that we can copy it somewhere and practice on the same sheet?
no, I think you can you can practice. No, I don't want you to edit it. I don't want you to copy it. I want you to write it yourself.
The whole.
Yeah, of course. No shortcuts. You have to write it yourself. That's why I'm not letting you copy anything. Okay, you must write it. You look at it as a reference, cross-check your numbers, but you have to write it yourself. You have to create the spreadsheet yourself. Okay? Okay, welcome. Okay, 1 minute.